Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate with your host, Kevin Perenio. As an owner and C-level executive for 20 plus years in finance, KP is here to serve you with all of his knowledge and experience. Whether you're a broker, realtor, or just interested in the economy, this is the podcast for you. So let's get started. Here's your host, Kevin Perenio.
Port Beach. We are down here on, I guess, the peninsula over here. It's Monday morning after Easter. Hope everyone has risen with positive vibes and ready to rock. I have an update on inflation. And remember, I did a walk here, I think it was back in August when I was out here. And I did a video talking about the supply chain. And it's just kind of an eyeball test. So this isn't like, scientific here. But if you remember all the cargo ships that pull into the port, and here, you can kind of see them here, right? They're in the background, and they kind of make their way. This is going north, and then up there is Port of Long Beach. Long Beach, they call it Port of LA. And now, this right here is the Newport Beach Pier. These boats were all the way, way out there. So just from the eyeball test, there's a lot less of them. And I don't know what that means, but maybe they hired more longshoremen. As you know, that's a worker group it's a unionized group that help load and unload cargo ships when they come into ports. And, I know that they've been hiring like crazy because, we have massive demand after we came out of this recession. And of course, the supply chain couldn't keep up with, you can't just turn the economy off and turn it back on. That's what we found out. We found out how truly fragile our economy is. And so I'm going to get into debt cycles real quick here, and I'm going to talk about probably the most important, aspect of the week, which is the Fed. They're talking on Thursday. Excuse me. So Fed Chairman Jay Powell talks Thursday. That will be the market-moving discussion of the week. Will he do more rate hikes? Will he do 50 basis point rate hikes? Higher than 50? What new details will he bring out and let the world know about? That's what we're all looking for on Thursday. So we know last week that the consumer price index and the producer price index, which are basically all the input costs, for what consumers pay for goods, were hot. Over 8.2%. Energy and food being the largest for consumers, and then the producer price index was massive as well. Energy being a massive input. We're back to $100 a barrel oil, a little bit higher now. And what's amazing is you have to have like physical construction for pipelines, rigs, and the ability to ship oil from where it's produced and then to where it gets refined, and then from where it's refined to other places. It's a tall ask. It's a tough ask. And so with the Russia-Ukraine conflict, unfortunately, there's been about 3% of the world's oil has been, put on blast a little bit. Overall, it's not a big deal, but it matters to places close to them like Europe, Germany, all these countries, that use a lot of Russian energy. By the way, at this place where I was eating yesterday, I asked for a Reuben sandwich, and on the menu, it said it came with Russian dressing, and I asked for Ukrainian dressing. And the lady said, well, I'm Russian. So it was kind of awkward, but then we had a good laugh about it. She was cool. Anyway, I just thought I'd throw that little down there. So look, this week is a big deal as we talk about the debt cycle. Typical debt cycles go from 5 to 7 years, okay? So it's been just over 2 years since we crashed. There's a lot of talk about recession right now. A lot of people are using the R word all over the place. And I'm just going to say this. Are we going to go into a recession at some point? Of course, at some point. Every cycle has ups and downs. When will it happen? Now, what's interesting is typically a debt cycle is from 5 to 7 years. It's been 2 years. Do we have a lot more legs in this bull market than people think? Will we actually navigate this soft landing? 1% GDP, even 0.5% GDP, 2% GDP is still growth. It's not high threes, but growth is growth, and growth is good. So one of these videos I look at on YouTube, it's by Ray Dalio from 2017. It's called Principles by Ray Dalio, and he's a huge hedge fund wizard, and he talks about debt and credit. Now, credit, obviously, we're in lending. We offer people credit because we think they're going to pay it back. The credit markets are super important to the growth of our economy. We have not seen credit shrink quite yet. In fact, as the 10-year yield gets up over 2.8, the spreads widen and banks tend to make more money. So that's actually a good thing for the financial centers, which we saw mixed results from the banks reporting earnings, last week and into this week. So what I would say is that credit has not started tightening yet. There's been no cracks, no defaults, no people who were offered credit in these last 2 years showing they can't make the payments. It's actually just the opposite. There's more money in the system than ever. And remember, the number that Ray Dalio throws out is there's about $3 trillion in cash, but there's $50 trillion in credit. This is like the Earth. It's like some weird statue here. They usually do like a market here on Saturdays. Anyway, so credit is what makes the world go round, not cash. And right now we are in expansion. So not a recession, we are in expansion. Now, we may be entering the later innings of an expansion, but we are still in economic expansion. Will the Fed slamming on the brakes slow down our expansion? Will the debt cycles be shorter now? Will they go from 5 to 7 to 3 to 5? Because there's so much money and we've got these rolling crashes, in the stock market in these different sectors, will we see more crashes in, certain areas while others stay healthy because there's just so much money in the system? I don't really know. But at the end of the day, the Fed is speaking on Thursday. It's a big deal. It will absolutely move the markets. So keep an eye on it. Keep an eye on rates. 2.82 yield on a 10-year treasury is a historic 40-year demarcation. So if you draw a line of a technical chart and you just draw it like all the way down from like 1981 or I think 83 when it was like 15 point something, it comes all the way down. It hasn't bumped up against that number just yet. So we'll keep an eye. If you see 2.82 or higher on the 10-year treasury, that's a game changer for credit and money and everything flying around the system. So hope you enjoyed the update from down here on Newport Beach. We'll have more to come. I'll probably get one out Thursday night after the Fed speaks. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.